Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at IREN.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. This one is really fascinating because the name IREN, it actually represents two completely different investment ideas right now.
Two different theses, you mean?
Exactly. We have to clearly separate them. On one hand, you have the Italian utility that's all about stability and yield.
Okay, the safe play.
And on the other, you have this high-performance computing and Bitcoin miner, which is, well, that's the hyper-growth, high-risk story.
Okay, let's unpack that. It's one name, but we're really talking about two very, very distinct businesses. What does that stability play look like?
So this is Italy's big integrated utility. It's all about regulated, predictable cash flows.
Right.
Its competitive moat is built on, vertical integration and basically a regional monopoly.
A monopoly, how?
Well, they control the regulated electricity and gas distribution in these really high-density areas like Emilia-Romagna. They're serving about 3.3 million customers.
So essentially, the barrier to entry is massive. You can't just build another grid. It would cost billions.
Billions, you got it. So what about their actual revenue drivers? Where's the growth?
Because utilities aren't usually growth stories.
Right. And for them, it's all about a heavy focus on green growth. Their fastest growing segments are renewable energy and waste-to-energy operations.
And that's growing faster than the rest of the sector.
Much faster. They've been growing revenue faster than the utility sector average in Italy.
Yeah.
In Q4 of last year, just their renewable energy division revenue, it hit over 214 million euros.
Wow, okay. And what about the financials? Does it look healthy?
Oh, it's a picture of health. Their net debt to EBITDA is pretty manageable at 2.9x.
That's solid for an infrastructure company.
Very solid. And they generated over 412 million euros in free cash flow last year.
And that's where it gets really interesting for income investors, right? The dividend.
Absolutely. They have a policy of prioritizing dividend growth. They offer a strong dividend yield, over 4%, and it's fully covered by that free cash flow.
Which means it's sustainable. They're not borrowing to pay shareholders.
Exactly. It signals a real commitment to returning capital, not just, relying on volatile share buybacks. It's a textbook defensive holding.
Okay, so that's the stable income-focused side of IREN. Now let's flip the coin completely.
Right.
Let's look at the other side, the high-growth entity focused on technology. What's driving this completely different narrative?
This entity, it operates in Bitcoin mining, but it's really executing a big strategic pivot right now.
A pivot into what?
Into the high-performance computing and AI cloud services market. This diversification, this shift, it's the key structural change you have to understand.
And the numbers that are coming out of this side of the business are something else.
They're astounding. Revenue last fiscal year was $501 million. That's a 168% year-over-year increase.
And it's accelerating.
It is. More recently, quarterly revenue jumped to over $240 million, which is up 355% year-over-year. And that swung their net income to a record $384.6 million.
From a loss the year before.
From a significant loss. I mean, that is a major, major turnaround story.
Wow. Okay, that is hypergrowth. But the AI infrastructure market is unbelievably fierce. What's their core competitive advantage here? How do they compete?
Their moat, it really comes down to two things: power and technology.
Okay.
First, they have proprietary access to low-cost renewable hydroelectric power. That alone lets them hit gross margins of around 68%.
68%. In an industry where power is one of the biggest costs.
It's a game changer. And second, they use their own proprietary direct-to-chip liquid cooling systems.
Which sounds very high-tech. What does that actually do for them?
Well, this technology significantly improves the unit economics. It just drastically reduces the power consumption you need for each unit of computing power.
I do remember a huge announcement they made earlier this year. Is that still the main catalyst everyone's watching?
Yes. The biggest external validation is that multi-year GPU cloud contract with a major tech player, Microsoft.
And that was worth...
What? $9.7 billion. It's positioning them as a specialized leader, sort of a neo-cloud provider.
But with that kind of hyper-growth and a deal that massive comes hyper-risk. What are the main concerns for this AI play?
The biggest risk is just one word: execution. The transition from Bitcoin mining to competing in the HPC space is incredibly capital intensive.
And they had to raise a lot of money for it.
A ton of money. They recently raised around $4 billion to fund all the GPU procurement and the expansion.
Which is necessary for growth, of course, but it brings in the risk of dilution.
Dilution. And it also raises questions about a potential funding gap. Is that $4 billion actually enough to fulfill that massive contract?
Right. And Bitcoin mining is still a piece of the puzzle, isn't it?
It is. It remains a material revenue contributor, which means they're still exposed to all the volatility of crypto prices.
So for the investor, it seems like timing is absolutely everything here. Both of these entities have some big catalysts coming up.
They do. In the immediate future, too.
Let's start with the stable utility play. What should we be watching for in the next few months?
For the utility, we're watching the Q1 earnings release. That's expected around May. Analysts are guiding for strong EBITDA growth, projected at over 280 million euros.
And they have an investor day coming up too.
Also in May. And that's where they'll outline their capital expenditure plan through 2027. That will be key for seeing their focus on expanding that renewables mix.
Okay. And for the high-growth AI company, where is their critical inflection point?
Their next major test is the Q2 earnings report. Everyone's waiting for that in early February of next year.
And what does the market need to see in that report?
Investors will be looking for clear clarity on how they're deploying that $4 billion they raised, and critically sequential growth in AI services revenue.
So if they keep ramping up that HPC revenue and show that their liquid cooling tech is expanding margins,
then it validates the whole turnaround story, the entire thesis.
yeah.
The market is basically betting on this success, seeing the current price as a time to get in before that growth really shows up in the numbers.
So what does this all mean for you, the listener? We've got one name representing two extremely different opportunities.
On one side, a defensive, high-yield infrastructure holding in Europe.
Versus an aggressive, high-growth AI infrastructure play with massive upside, but it's all tied to that Microsoft deal.
It just means you absolutely must know which IREN you are looking at. If your goal is safety and income, the European utility with its 4.1% yield and that regulated moat, that's the answer.
But if your goal is capitalizing on the AI boom, and you're willing to accept significant execution risk for that potential hypergrowth,
Then the technology company is the one to focus on. Both offer really compelling narratives, but for completely opposite reasons.
which raises an important question, doesn't it?
It does. Given this huge structural shift towards AI infrastructure, is the market fully appreciating the long-term, high-margin advantages that come from proprietary tech, like direct-to-chip liquid cooling?
That's a great point to end on. That's definitely something worth mulling over.
Absolutely.
Thank you for that excellent breakdown. And don't forget, if you want to stay on top of these complex situations, please subscribe, like, and comment to support Smart Wealth with Joshua. We'll be back tomorrow with another stock analysis.